Imagine a tiny island nation, smaller than the state of Oregon, that once controlled 24% of the entire world's land surface, printed the world's reserve currency, built the first central bank, and created a financial system so powerful that even after losing its empire, its capital city still remains the #1 global financial center by several key measures. That nation is the United Kingdom. And today, we're going on a 400-year journey through real data, real numbers, and real history to answer one of the most fascinating questions in economic history. How did Britain become the world's greatest financial power? Stay until the end, because the lessons here apply directly to the world economy right now. Let's go back, way back, to the 1300s. England's first real source of wealth was wool. Yes, sheep. England was producing roughly 30,000 sacks of wool per year by the mid-1300s, making it the single largest wool exporter in all of Europe. Flemish and Italian merchants would travel thousands of miles just to purchase English wool. But here's what's critical. England didn't just sell raw wool forever. By the 1500s, England had shifted to exporting finished woolen cloth, capturing far more of the value chain. By 1540, cloth accounted for over 80% of England's total export earnings. This is your first economics lesson from British history. Move up the value chain. Then came the great explorers. In 1600, Queen Elizabeth I granted a royal charter to a group of London merchants. They called it the East India Company. With initial capital of just £72,000 raised from 218 investors, this company would eventually control trade across Asia, command its own private army, and, at its peak, account for half of all world trade. By 1690, English overseas trade had grown to roughly £6.5 million per year. Compare that to roughly £1.5 million in 1550, a more than four-fold increase in 140 years. The engine was running. Now here's when everything changed, the moment that separated Britain from every other nation on Earth. The year is 1694. England is at war with France. King William III desperately needs money, specifically £1.2 million, to fund his military campaigns. He can't raise it fast enough through taxes alone. A Scottish merchant named William Patterson had an idea. What if a group of private investors lent the government this money in exchange for the right to issue banknotes and collect interest? The deal was struck. On 27 July 1694, the Bank of England was founded, the world's first modern central bank. The terms? The bank lent the government £1.2 million at 8% annual interest, plus a management fee of £4,000 per year. In return, it received the right to issue banknotes up to the value of its capital. This was revolutionary for three reasons. First, it gave the British government a reliable, scalable source of borrowing, meaning Britain could fund wars and infrastructure that other nations simply could not. Second, it created credibility. Because the Bank of England backed government debt, interest rates on British government bonds, called gilts, were dramatically lower than competitors. By the 1720s, Britain was borrowing at just 3 to 4% interest, while France was paying 8 to 10%. Lower borrowing costs equals a massive strategic advantage. And third, it laid the groundwork for a modern monetary system built on trust, paper money, and credit. Compare this to France. France had no such institution. In 1720, the French government's attempt at a similar system, John Law's Mississippi Company, collapsed catastrophically, wiping out tens of thousands of investors in what became history's first great financial bubble. Britain had the infrastructure. France did not. Fast forward to the 1760s. Britain is about to experience the most transformative economic event since the invention of agriculture, the Industrial Revolution. Here's what the data shows us. In 1760, Britain produced approximately 2.7 million tons of coal per year. By 1850, that number had exploded to 49 million tons, nearly 20 times the output in just 90 years. Cotton production followed the same trajectory. In 1760, Britain imported roughly 3 million pounds of raw cotton. By 1841, that number had reached 490 million pounds, a staggering 163-fold increase. And GDP? Britain's real GDP per capita in 1760 was approximately £994 in 2013 prices. By 1850, it had risen to roughly 2,330 English pounds, more than doubling in less than a century at a time when most of the world had seen virtually zero economic growth. By 1850, Britain was producing approximately 50% of the world's iron, 50% of the world's cotton cloth, and around 40% of all hardware goods globally. This tiny island of 18 million people was the workshop of the world. But here's the connection to finance that most people miss. The Industrial Revolution wasn't just about machines, it was about capital. Factories needed investment, railways needed funding, banks and the London financial markets stepped in to provide it. Between 1825 and 1850, over £230 million was raised on the London Stock Exchange to fund railway construction alone, equivalent to roughly £25 billion in today's money. The London capital markets were becoming the engine that powered not just Britain, but the entire world. After Napoleon's defeat at Waterloo in 1815, Britain stood alone as the world's undisputed superpower. The numbers are almost incomprehensible. By 1820, Britain accounted for roughly 36% of world manufacturing output. By 1870, the British Empire covered 22.5 million square kilometers, about 25% of the Earth's total land area. It governed over 400 million people, roughly 23% of the world's population at the time. And backing it all was the pound sterling, the world's first true global reserve currency. In 1844, the Bank Charter Act formally tied the pound to gold, the so-called gold standard. Every pound in circulation was backed by actual gold in the Bank of England's vaults. This created something priceless, absolute trust. By the 1870s, over 60% of all global trade was conducted in British pounds. International contracts from Buenos Aires to Bombay, from Hong Kong to Hamburg, were denominated in sterling. The City of London became the world's banker. London's merchant banks, names like Baring Brothers, Rothschilds, Hambros, and Schroders, financed railways in Argentina, canals in the United States, governments across Asia and Africa. By 1913, on the eve of World War I, Britain had accumulated foreign investments of approximately £3.5 billion, equivalent to roughly 1.5 times Britain's annual GDP. No nation in history had ever invested so much abroad. And the return? Britain was earning roughly £200 million per year in investment income from overseas, money flowing back to London without lifting a finger. This was the machine at full power. Then, everything changed. World War I, from 1914 to 1918, cost Britain an estimated £10 billion in total, roughly 170% of GDP at the time. To fund it, Britain was forced to liquidate vast chunks of its overseas investments and borrow heavily from a new creditor, the United States. By 1918, Britain had gone from the world's largest creditor nation to a net debtor to America for the first time. The U.S. Federal Reserve, established in 1913, was flexing its muscles. The dollar was rising. World War II was even more devastating financially. Between 1939 and 1945, Britain spent approximately £28 billion on the war effort. The Lend-Lease program from America provided critical supplies, but came with strings attached, including a requirement that Britain dismantle imperial trade preferences. By 1945, Britain's national debt had reached 250% of GDP, one of the highest ratios in the developed world at the time. The empire began to unravel. India gained independence in 1947. Over the next 2 decades, over 50 colonies would follow. The sterling area, the group of countries using the pound, shrank dramatically. and in 1967, the British government was forced to devalue the pound from $2.80 to $2.40, a 14% devaluation that shocked the world and symbolized Britain's diminished status. Britain was down, but it was absolutely not out. Enter Margaret Thatcher. When she came to power in 1979, Britain was in crisis. Inflation was running over 20%. Unemployment would soon exceed 3 million. The economy was stagnant. Trade unions were crippling industry. The national mood was one of managed decline. Thatcher's response was radical. She deregulated. She privatized. She broke the power of the unions. And most crucially for our story, she unleashed the City of London. The pivotal moment came on 27th October 1986. It was called simply the Big Bang. In a single day, the London Stock Exchange was transformed. Fixed commission rates on stock trades were abolished, slashing trading costs. The distinction between stockbrokers and market makers was eliminated. Foreign firms were allowed to own British brokers for the first time ever. Electronic screen-based trading replaced the old open outcry floors. The effect was explosive. Within 5 years, daily trading volumes on the London Stock Exchange increased by over 400%. Foreign banks flooded into the city. American giants like Goldman Sachs, Merrill Lynch, and J.P. Morgan set up major London operations. Japanese banks followed. London re-established itself as the premier global financial center, competing directly with New York. And the numbers prove it. Between 1986 and 2000, the financial services sector's contribution to UK GDP more than doubled. By 2000, financial and business services accounted for approximately 25% of UK GDP. The city was back, louder, more global, and more powerful than ever before. So where does the UK stand today? Let's look at the hard data, because the numbers are remarkable for a country that lost its empire. Foreign exchange trading. London is the world's largest foreign exchange market. According to the Bank for International Settlements, London handles approximately $2.7 trillion per day in forex transactions. That's 38% of all global forex trading. New York is second at around 19%. That means London does twice as much forex trading as its nearest competitor. International banking. The UK is home to more international banking activity than any other country. Over 250 foreign banks have operations in London, more than any other global financial center. Asset management. London is the second largest asset management hub in the world, with approximately $9.1 trillion in assets under management, second only to the United States. Insurance. Lloyd's of London, founded in a coffee house in 1688, remains the world's leading specialist insurance market. It insures everything from satellites to celebrity body parts, writing approximately $47 billion in gross written premiums annually. Legal and professional services. English contract law governs approximately 40% of all global commercial contracts, an invisible but extraordinarily powerful form of financial influence. Financial services exports. The UK financial sector generates a trade surplus of approximately $60 billion per year, making it by far the largest net exporter of financial services in the world. The City of London is, by multiple measures, still the financial capital of the planet. So now the critical question. Why? Why did this happen in Britain and not somewhere else? There are 5 key factors that explain Britain's financial supremacy. Number 1, geography. London sits in the perfect time zone, bridging Asia's morning markets with America's afternoon trading session. There is a 2 to 3 hour window every day where London overlaps with both Asian and North American trading hours. This geographic luck has been leveraged brilliantly. Number 2, the rule of law. Britain's common law system, dating back to Magna Carta in 1215, provides one of the world's most robust frameworks for contract enforcement. Businesses from around the world choose English law because they trust it. This is an 800-year competitive advantage. Number 3, political stability. Britain has had no revolution, foreign invasion, or complete governmental collapse since 1688, over 335 years of continuous institutional stability. For financial capital, which abhors uncertainty above all else, this is priceless. Number 4, the English language. As the global language of business, English gives London a natural advantage in attracting international talent and commerce. The best minds from India, Africa, Australia, America, and beyond can work seamlessly in London. Number 5, first mover advantage. Britain invented many of the foundational tools of modern finance: the central bank, the joint stock company, modern insurance, the gold standard, the commercial bond market. When you write the rules, you have a structural advantage that takes centuries to erode. Now, we can't tell this story honestly without addressing the elephant in the room: Brexit. When the UK voted to leave the European Union in 2016, many predicted catastrophe for London's financial sector, and there has been genuine damage. Approximately 7,000 financial jobs and $1.3 trillion in assets have shifted from London to EU cities, primarily Dublin, Paris, Frankfurt, and Amsterdam, since the Brexit vote, according to EY research. Amsterdam has, for specific metrics, like share trading in EU-listed stocks, overtaken London temporarily. Euro-denominated derivatives clearing, once a $60 trillion per day business overwhelmingly concentrated in London, has seen pressure from EU regulators pushing it to relocate it to the continent. However, and this is important, London has not collapsed. It remains, by the data we've discussed, the world's leading international financial center. Many of the predicted job losses did not materialize at the scale feared. But there are other long-term challenges, too. Singapore and Dubai are aggressively positioning themselves as alternative financial hubs. Singapore now manages over $5 trillion in assets and has become the preferred location for Asian wealth management. New York continues to press its case, especially as U.S. equity markets remain the world's largest by capitalization, with the NYSE and NASDAQ listing over $40 trillion in total market capitalization. And then there's the question of digital finance. As crypto, DeFi, and central bank digital currencies reshape the monetary landscape, the question is whether London's traditional advantages in legal expertise, human talent, and institutional trust translate into the digital age. The early signs are encouraging. London has established itself as Europe's leading fintech hub, with over 2,500 fintech companies and more fintech investment than any other European city. So what are the lessons from this extraordinary 400-year journey? Lesson 1. Institutions matter more than resources. Britain had no oil, no vast fertile plains, no huge population compared to China or India. What it had was a central bank, a rule of law, and a political system stable enough for capital to feel safe. Institutions beat geography every time. Lesson 2. Financial innovation compounds over time. The Bank of England, founded in 1694, didn't just help Britain borrow for one war. It created a 300-year compound advantage in cheaper capital, deeper markets, and greater investor trust. The power of financial infrastructure is measured in centuries, not quarters. Lesson 3. Adaptation is survival. Britain lost its manufacturing supremacy. It lost its empire. It lost its currency's reserve status. Every time it adapted, from wool to finance, from empire to investment banking, from fixed commissions to electronic trading. Nations, like businesses, die when they stop reinventing themselves. Lesson 4. Networks are nearly impossible to replicate. The City of London's web of banks, law firms, accountants, insurers, exchanges, and regulators has been built over 300 years. The sheer density and quality of that ecosystem is extraordinarily difficult for competitors to replicate, even with billions of dollars of investment. Britain's story is a masterclass in how a nation with limited natural resources can, through smart institutions, strategic innovation, and relentless adaptation, build a financial empire that outlasts even its political one. The sun may have set on the British Empire, but the lights of the City of London, flickering all night as traders move billions across continents, are still very much burning bright. If you found this video valuable, please hit the like button. It genuinely helps this channel reach more people who care about understanding the real mechanics of global finance and history. And if you want to go deeper, subscribe, because our next video looks at how the United States took the global reserve currency from Britain after World War II and what that shift meant for every single person on the planet. Drop in the comments below. Do you think London will maintain its position as the world's top financial center over the next 50 years? I read every comment. Until next time, stay curious, stay informed.